You knew the rule. You wrote it down in your journal in clear block letters. You swore an oath to yourself that this time you would follow it. And then, in a moment of market-induced fever, watching the screen flicker, you broke it. You held on to the loser a day too long. You sold the winner a week too soon. You doubled down when your first instinct screamed to get out. The result was the same as always, a sharp, sickening drop in your account equity and that familiar, cold knot of regret in your stomach. This game is not about finding some hidden secret. It is about the lonely, daily, hourly battle against your own worst enemy, yourself. And your only shield in this battle is discipline. Discipline is not a suggestion. It is not a guideline. It is the bedrock of your entire operation. Without it, you are not a speculator. You are a gambler, pulling the lever on a slot machine, hoping for a jackpot that will never come. The market does not care about your hopes. It does not recognize your intelligence. It is a vast, impersonal ocean of capital, and it will drown the undisciplined without a second thought. Why is this so difficult? Because the human mind is wired for the very behaviors that lead to financial ruin in the markets. We are built to hope when we should fear, and to fear when we should be confident. When a stock moves against you, your instinct is to hold on, to give it a little more room, to hope it will come back. You've turned a trade into a prayer. You have substituted wishful thinking for market analysis. This is the siren song of the novice, and it leads directly to the rocks. Conversely, when a stock moves in your favor and you have a respectable profit, what does your mind do? It whispers of fear. Fear that the profit will evaporate. Fear that you will give it all back. So you snatch the small gain, feeling a moment of relief, only to watch in agony as the stock continues its true move for weeks, even months, leaving you with a pittance while the real money was made by those with the discipline to sit tight. Greed, hope, fear, and ego. These are the four horsemen of the trading apocalypse. They live inside your head. Discipline is the cold, hard set of rules you create to exorcise them from your decision-making process. It is an unnatural act. It requires you to act contrary to your deepest impulses. That is why so few succeed. They believe they can outsmart the market. I am here to tell you, you cannot outsmart the market, and you cannot outsmart yourself. You can only control your actions through a rigid, unyielding code of conduct, your rules. I learned this lesson at a cost that would shatter most men. It was in cotton. I had been fantastically successful, building a fortune from my analysis of the tape. I felt I could not be wrong. My name was spoken with a certain awe. The ego, you see, had begun to swell. I was no longer Jesse the speculator listening to the market. I was Livermore the Great, telling the market what it should do. I had a very strong conviction that cotton was headed for a significant decline. The tape confirmed it. My own system of pivotal points confirmed it. I established a large short position, and the market began to move in my favor. The profits were accumulating rapidly. But then a man, a very famous and supposedly brilliant cotton trader named Percy Thomas, began to tell me I was wrong. He was an authority, a man with decades of experience. He argued with conviction that the bull market in cotton was far from over. He presented compelling arguments. He had statistics, sources, a whole narrative. And I, in a moment of supreme arrogance, began to listen to him instead of the tape. The market action was screaming sell, but Percy Thomas was whispering buy. My ego, already inflated, could not bear the thought of being on the opposite side of such a renowned expert. Worse, it could not bear the thought of being wrong in front of him. So, I did the unthinkable. I violated my own cardinal rule. I abandoned the clear message of the market action and listened to an outside opinion. I not only covered my profitable short position, I went long. I bought cotton, then I bought more, averaging down as the price began to sag. The tape told me I was wrong with every tick, but my ego, now lashed to Percy Thomas's reputation, refused to let go. I was no longer trading the market, I was arguing with it. And the market always wins the argument. The losses mounted. They became staggering. I was trapped, paralyzed by hope and ego. Hope that Thomas would be proven right, and ego that could not accept the magnitude of my own foolishness. I held that position far beyond any rational stop-loss point. It did not just hurt me. It led to a complete account blow-up. It sent me into a financial wilderness for years. All because I broke one rule. Listen to the market, not to men. That expensive education taught me that discipline is not something you have. It is something you do. Every single day. On every single trade. It is the conscious decision to subordinate your feelings to your system. Without a system, a set of rules, you are merely guessing. Jesse Livermore, or Larry Livingston as he was known in print, consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk $1 of your own capital. To ensure this timeless wisdom translates accurately to the modern computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. I give you the discipline and the mindset. My stories are here to steel your nerves and clarify your thinking. But for the precise mechanics, exactly where, how, and when to execute the trade, you need the structure of Richard Wyckoff. He was my contemporary, a titan of tape reading who codified the market's behavior into a repeatable, logical method. His work on accumulation and distribution, on identifying the actions of large operators, is the perfect complement to my philosophies. He provides the schematic, the engineering blueprint for the market movements I describe. I teach you the why. Wyckoff teaches you the where and when. I have left the link to his channel in the description below. Use it to complete your arsenal. Do not neglect the tactical side of this business. So how do you apply this in today's electronic markets where prices move at the speed of light? The principles are identical. The tools are merely different. Your discipline must begin before you ever place a trade. It starts with a written trading plan, not a vague idea in your head, but a physical or digital document. This document must state, in unambiguous terms, your rules of engagement. First, your entry criteria. What precise set of conditions must be met for you to risk your capital? Is it a breakout above a multi-month consolidation? Is it a test of a key support level on high volume? Write it down. If the market does not present this exact setup, you do not trade. You sit in cash. Your default position is always cash. You are paid to wait for the perfect pitch. Let's consider a practical example. Imagine a major copper producer. For months, its stock has been trading in a wide, volatile range, let's say between $40 and $50 a share. There is no clear trend. The crowd is confused, buying at the top of the range in excitement and selling at the bottom in panic. You, the disciplined speculator, do nothing. You simply watch and wait. Your rule states you will only act when the line of least resistance is clear. Then one day the price moves toward the top of that range, to $50. But this time is different. The volume swells dramatically. The price doesn't just touch 50, it pushes through it with force, closing the day at 51. This is your signal. The chart is telling you that the character of the market has changed. The battle between buyers and sellers has been won, and the buyers are in command. Your entry rule has been met. You enter the trade. Second, And this is the most critical part, your exit criteria. Before you press the buy button, you must know where you will exit, both for a loss and for a profit. Your stop loss is not a number you hope will never be hit. It is the price at which your entire thesis for the trade is proven wrong. In our copper example, the breakout occurred at $50. A logical place for your stop would be just below that level, perhaps at 48.5. If the price falls back below that breakout point, the move was false. The thesis was wrong. You do not hope, you do not wait, you do not pray, you exit. The loss is taken cleanly and without emotion. It is the cost of doing business. By defining it beforehand, you strip the ego out of the decision. You are not a failure. Your setup simply did not work this time. Your profit-taking rule is just as important. Are you aiming for a specific price target? A 20% gain? Or will you trail your stop loss, moving it up as the stock advances, allowing the winner to run as far as the market will take it? There is no single correct answer, but you must have an answer written down in your plan. The undisciplined trader lets the market dictate his emotions. The disciplined trader has a plan for every contingency. Third, money management rules. How much of your capital will you risk on any single idea? 1%? 2%? This is your shield against ruin. Even a string of losses will not cripple you if your risk is properly managed on each trade. A large loss is the speculator's mortal enemy. It inflicts not only financial damage, but psychological damage that can take months, even years, to repair. Small, manageable losses are a natural part of the business. Your discipline in position sizing ensures that no single trade can ever deliver a fatal blow. Now let us address the inevitable. You will fail. There will be days when your emotions get the better of you, when you break your own sacred rules. The key is not to avoid this forever, for we are only human, but to have a protocol for when it happens. Consider this scenario. You followed your rules perfectly. You bought the copper stock at the breakout. It moved in your favor. But then, a sharp one-day pullback spooks you. Fear takes over. You violate your plan and sell, taking a small profit. The next day, the stock resumes its powerful advance, leaving you behind. What do? First, you do not chase it. Chasing a stock is a cardinal sin, born of regret and greed. You have missed the move. You must accept it. Second, you open your journal and conduct a post-mortem. Write down exactly what happened. I sold because of fear, not because my sell signal was hit. I violated Rule 2B. You must confront the error in writing. This act cements the lesson. Third, you might consider reducing your trading size for the next few trades. You have demonstrated an emotional weakness. You must re-earn your own trust by executing flawlessly on a smaller scale before returning to your normal size. Now, the more dangerous scenario. You break a rule, and it works. You hold on to a loser long past your stop loss, and it miraculously turns around and becomes a winner. Your account balance goes up, but you have just inflicted a terrible injury upon yourself. You have taught your brain that violating discipline can be profitable. This is a poison that will rot your entire approach over time. The market has given you a reward for a terrible habit. In your journal, you must mark this trade as a failure. Yes, a profitable failure. You must write, I made money on this trade, but I was lucky. I violated my stop-loss rule and was bailed out by randomness. This is not a repeatable process and is a path to eventual ruin. Acknowledging this is the only way to inoculate yourself against the deadly disease of rewarding bad behavior. Discipline is not about being a robot. It is about building a professional framework around an inherently emotional endeavor. It is the dam you build to protect your capital from the floods of fear and greed. It is the compass that keeps you on course when the fog of market uncertainty rolls in. The undisciplined trader is a leaf in the wind, tossed about by every rumor and every frightening headline. The disciplined speculator is a ship captain. He cannot control the ocean, but he has his charts, his compass, and his hand firmly on the rudder. He knows his destination, and he has a plan to navigate the storms. The market will always be there. Tomorrow, next week, next year. There is no need to rush. There is no need to force a trade where none exists. Your task is not to be in constant action. Your task is to wait patiently for the high probability setups that conform to your rules, act decisively when they appear, and then manage the trade according to your predetermined plan. That is the whole game, from beginning to end. It is simple in theory, yet profoundly difficult in practice. Every tick on the screen is a test of your resolve. Every news story is a temptation to abandon your plan. Your rules are your armor. They will not make you right every time. Nothing can. But they will keep you in the game. They will protect you from the catastrophic errors that wipe traders out. They will allow you to survive the inevitable strings of losses and be psychologically and financially prepared to capitalize on the great moves when they come. In the end, the stock market is a game of survival. The winners are not the most brilliant nor the most aggressive. They are the most disciplined. The tape is always talking. Your job is to listen, not to argue. Stay disciplined. Stay